Good afternoon, ladies and gentlemen, and welcome to the Sullivan & Worcester London office April webinar entitled An Update on Developments in the Creation and Financing of Trade Assets, How to Get Involved. I'm Geoff Wynne, and I head the London office and our trade and export finance practice. And what I'm going to do is initially, and unusually, is to tell you what I'm not going to talk about specifically, because I've been following lots of articles that have been going on over the last few days. So I'm not going to talk about the digitalization of trade and trade finance. Many of you may be pleased to know. I'm not going to talk specifically also about some headlines that there's been a drop in payables financing and an increase in receivable financing, although I will talk about those two subjects. And I'm also not going to talk about the value of LEIs, legal entity identifier, although as you will see later on that may also have some use in what we are going to be talking about. So what am I going to cover? Well, there's been quite a lot of interest and quite a lot of discussion about this subject. And what I'm going to try and do is to answer questions, to explain some of the issues, to give you some solutions to look at the way forward. But clearly the starting point is to grow the market in trade or trade financeable assets, particularly to involve those who've not seen them before, particularly the non-bank investors. So I'm going to look at what's happening. I'm going to look at what are trade assets, to look at who might need the finance for them, who can or wants to finance them, and who could. And then how non-banks in particular might become involved in trade finance assets, and how those of you listening can do more in relation to trade finance assets. I'm naturally going to look at legal issues and documentation issues, and I hope to conclude with some thoughts about where we go from here. So what is going on? Well, there are various initiatives. My most recent relevant experience was last week. I was at the BCR ITFA-sponsored Trade and Investment Forum, which had as its heading, Making Trade Finance an Investable Class. I've also spent quite a bit of time with ITFA's ITFI working group. That's the ITFA Trade Finance Investment Ecosystem. For those who may remember, there was a white paper issued in 2022, and we recently followed up at the conference last week with the first draft of rules of the game, an explanation, if you like, of trade finance, with some guidance, and beginning to suggest some common standards and definitions relating to the creation and, more importantly, the distribution of trade assets. So the importance was therefore to understand what trade assets are, and then how you might distribute them. So the first thing, well, what are trade finance or trade financeable assets? And this is, if you like, a start at the beginning. Supply chain as a concept is very popular, but also just the creation of receivables generated from the sale of goods and services. And the converse, as you'll hear, of receivable is a payable. In other words, what the buyer might pay. And I'm going to look at that in the context of how they can be financed and consequently how you can invest in them. But there are other payment obligations that may be very relevant when looking at trade finance assets, which the investor might want to buy into. Promissory notes and bills of exchange, very classic trade finance instruments, but also loans, which give you an interest rates that work, and other payment obligations, like, for example, deferred payments under documentary letters of credit. And then in addition to that, I've talked about funded, and I'll explain that. There's unfunded, where you want to take a risk. There might be guarantees. There might be standby letters of credit, where you get a fee for taking the risk, but don't have to pay up unless there is a problem. And the concept here is that all should have an underlying trade transaction, which gets you, of course, to one of, if you like, a favorite subject, which is, what is a trade finance asset? An asset created in the financing of trade and consequently requiring an underlying trade transaction. But then you need to define what you mean by an underlying trade transaction, and then ask, does what you're being offered meet that test? In other words, how closely related is your trade finance debt to the asset being financed? And that gets you to structuring issues as to where an investor might step in, because the investor clearly wants to know, what rights am I investing in? What am I financing? That will take us, as we'll discuss later, to the structuring issues on that. Now, I open this with the IPU. To achieve an IPU or better is clearly a good idea when looking at a payment obligation. But what does IPU mean? Now, my preference has always been that it's an irrevocable payment undertaking. In other words, you have certainty that a payment promised will be made. But some argue that it is better to have IPU, meaning an independent payment undertaking. But there could be problems with that, as you'll see later, particularly from an accounting point of view. But conceptually, what we're looking at here is a clean, if I say non-payment risk, but of course, what I really mean is a clear payment right to receive, and therefore a clear basis on which the risk of non-payment might be taken. So what is trade finance debt? Well, at its simplest, it may be a payment for goods and services, for example, and it gets phrases that we've seen used in the past, like, is it true trade? Is it true related? Or is it just an excuse to create a basis for just working capital? Does it matter? Well, to whom would it matter? Well, the supplier and the buyer perhaps don't mind at all, because they sell, they buy, and they make payment for the goods that or services that are sold or delivered. So does it matter to the seller of the debt, or the participant, like the investor? Does it matter to anybody offering credit support, like credit insurance, who might say, well, actually, I only want to finance what I can see clearly relates to trade debt? Is it trade debt? Well, one of the arguments has been, if you make the debt move away from being a simple payable for a known delivery, particularly if it becomes payable to a bank, has that turned that debt into bank debt? And that means the question is that more than a balance sheet problem? Is it actually a problem of what have I bought? Because a view has often been expressed that if I hold trade debt, in other words, if I am the creditor of a party that has issued an instrument that is trade debt, I may get better treatment in an insolvency or in a workout. And there have been historic examples where that might be the case. So that's a point that we need to bear in mind. The better the quality of the trade debt, the more likely somebody might say, that's not trade debt anymore, that's just simple debt on your balance sheet. And then we have a separate point, which is, having got a trade finance debt, how would you transfer it? But the question at the moment, you have to decide what is being transferred. Am I transferring the risk and benefit of a payment or a non-payment, or do I want more? Do I want the party that I am dealing with to take more risk in relation to the transaction? Do I want that party to be subject to documentation risk, to sanctions risk, and so on? And this comes on to how we might structure the involvement of parties into trade finance debt. Another issue to consider is I have a trade finance debt. Let's just assume that that's right. And I'm looking at that in a moment in the definitions of rules of the game. But two issues come up. One, has there been a legal true sale? What does that mean? Has that been a transfer from the party that holds the debt, be it the supplier, be it the person who's bought it from the supplier, to the investor? Has the ownership of those rights been transferred to the acquirer of those rights, the participant, the investor? Has it been sold? Has it validly been bought? What do I need to achieve that? Do I need direct recourse to claim the payment if I'm the purchaser of that debt? The answer is not necessarily, and you'll see where we get to. But having achieved a legal true sale, have I also achieved what seller and buyer of the debt want, which is an accounting true sale? Is that more than legal true sale? Well, the answer is, in the view of the auditor, yes, it is. Because have I achieved, if I'm selling, the derecognition of that asset in my balance sheet in replaced by cash? If I'm the buyer, have I got all the rights? But does the seller still have residual obligations in which he has to make a note to say that the sale was not complete? And that, of course, may depend on the structure of the sale of the trade finance debt. Is there recourse to the seller? And if the recourse to the seller relates to matters of which the seller has control, we would argue that that could still be a true sale. So the answer is, can you achieve a true sale? Of course, by documenting carefully, but who needs to be convinced? Banks, bank credit committees, compliance committees, seller of the debt, buyer of the debt, auditors, and so on. So there's a fair bit to do in relation to how we might structure that sale. Let's assume we've got a trade finance asset for the moment. What is that asset? Well, it might be a single asset. It might be a loan. It might be a receivable. It might be a deferred payment undertaking under a letter of credit. If we've got that single asset, we can then work out how we can transfer it, how we can transfer the rights, and how we can transfer the obligations in respect to. But of course, if you're doing it with documentation, it may be useful to bundle up those assets. How would you bundle up those trade finance assets? Well, you might have a single obligor. You might have a single purchaser, a single buyer of goods, and you can take a view on that buyer. You might equally deal with the seller of trade finance assets like receivables, where he sells to multiple buyers, but you're buying these trade finance assets from one seller. That, of course, is absolutely fine, and we can do quite a lot with that. But there are, of course, attractions of pooling the assets, of having a diversified portfolio for an investor. And then we start looking at, well, hang on a second. That's nice to have a diversified portfolio, but should I limit what is in my portfolio? And a couple of ways which we'll come on to is a concentration risk. In other words, I want it diversified, so I don't want to take risk in a single party. I want multiple parties, so I may set maximums. Eligibility criteria. What am I buying? Am I buying receivables generated from sales of different commodities, different countries, and so on? So all of these then become relevant as a description of a portfolio of pooled assets and how to get there. Use of credit insurance, third-party support like sureties, they enhance the value of the trade finance assets and have a value because the party issuing the credit insurance, the surety, the guarantee, may take a different view of risk on that. And that allows for the packaging of trade finance assets in a different way. Now I'm going to look at how to unpackage everything that I've said to explain what we all mean. And the first thing that we did at ITFI was to try to explain all of the elements so as to give an overview of the trade finance market, particularly for non-bank investors. The first version of Rules of the Game, to those who attended the BCR event last week, will have seen that. But the idea is that that was very much a draft to start showing the guidance, the definitions, the structures. And we're going to work on a more detailed, with more input from parties to look at later on. What I'm going to do here is to explain a bit more what's in and what will be in the rules of the game. And therefore to start the explanation of the way in which trade finance assets can be invested in. What are the issues to bear in mind? The structures, what are those structures that are being bandied about, being offered? And then what documentation do you use to achieve any of this? And the idea is to achieve some sort of common understanding as we move forward, having explained the different structures which depend on how a trade finance asset is created, how it might be transferred, and to whom it might be transferred. And then the sort of documentation that we think we're likely to see used. And the rules are guidance. They don't give legal advice, but they help to keep everybody on the same page when discussing trade finance and trade finance assets. So what was the key to doing that? Well, the answer was a glossary of terms. And we thought that might be quite easy to achieve. But in reality, it's an interesting challenge. I've explained, if you like, trade finance assets, and that should, you would think, be easy. But there are many different ways to describe a receivable. In fact, one of my colleagues on the committee gave me a number, and I think it was over 50 ways of describing a receivable. I'll explain that in a moment. But of course, what's interesting is that one person's receivable is another's payable. Look at it quite simply in a trade transaction. A supplier sells goods to a buyer. So the two parties involved are the supplier and the buyer. The supplier has a receivable and the buyer has a payable. Then, of course, to confuse matters, if the supplier sells the receivable, perhaps to a bank, perhaps to an investor, perhaps to a platform or whatever, it suddenly becomes the seller. So we're creating definitions, if we're not careful, designed to confuse people. Can I break that down? Well, keeping to my example, when a supplier sells, it normally uses an invoice. So it invoices the buyer. When a buyer starts that process, it uses a purchase order. With luck, the invoice and the purchase order match. Goods are delivered. Does the buyer accept? Well, that's a good question. The buyer accepts the goods. He accepts the invoice, but is that enough? Well, of course, he might accept the invoice, but he may say, but of course, I've got a credit note that I need to apply to this invoice. I'm entitled to a discount because I've now exceeded the minimum amount. In other words, this discussion between suppliers' rights and borrowers' obligations depends on valuing the invoice. How much is it? When is it going to be paid? Now, the value of supply chain finance which I'm not going to go into, is designed to get the supplier paid early and the buyer to have time to make a payment on that. It's a good tool. We can debate that and will do ongoing. So what does approved invoice mean? Can we get to approved payable? In other words, the amount on that invoice, the buyer says, I'm going to pay it in full and on a particular date. Would he replace that invoice with the infamous IPU, irrevocable or independent payment undertaking? Would he exchange it for a promissory note? Can I take you into briefly the digital world? Could he change it for an electronic promissory note? Some hope that he will, but actually he could change it just for an electronic record where there would be matching data from supplier and buyer, which give rise to that obligation to pay. So what's the key in all of this? Well, the answer is the key is certainty. What is my trade finance asset? Is it certain? So what is the obligation that's being sold by, if you like, the supplier, the seller of that receivable? What is the payment? Because the seller sells the right to receive the payment. The buyer of the goods has a payable, and the purchaser of the receivable wants to know that it can claim against the buyer or another obligor. What is the payment? Well, I've talked in terms of trade finance. The loan is the same thing. Have I become the lender? In other words, has the borrower of the loan agreed to make payment to me? Has the issuer of the payment undertaking, the issuing bank and a letter of credit, agreed that its payment undertaking is irrevocable and it will pay on the maturity date the full amount? What about other obligations? Are they clear? Is it certain? The same. What about the risk in relation to a claim under a guarantee? Who checks that the claim is valid? Who takes the risk in relation to the non-payment in respect of which a guarantee then gets claimed? And if as an investor, you've agreed that you will cover that claim, how do you recover? So the simple answer to all of this is parties in this really want certainty of payment and certainty of timing of payment. In other words, is this about credit risk in relation to a specific amount on a specific date? And if that's the case, can I discount it? So I pay a percentage of the amount. Will I get interest or a fee for lending my name to that risk? So with all that in mind, how do you then want to become involved? Well, the answer is, how would I invest in a trade finance asset? And that's the key question. So first of all, hopefully I've given you an idea that there is a multitude of possibilities in relation to trade finance assets. Now let's look at the definitions in relation to how you can acquire a trade finance asset. The first one, and perhaps the simplest, might be the most desirable, but I'll come on to that in a moment. Become the lender of record if it's a loan, become the asset owner of record if it's a payment obligation, if it's a receivable. And use mechanisms generically called transfer, but as a matter of English law, when it is a debt, we call it an assignment. And that, of course, confuses a lot of non-English lawyers as you'll hear again in a moment, that you can assign, if you like, the right without taking the legal title. An equitable assignment, for those in the know, when you get the full title, you get a legal assignment. But that works for assignment of debts. But actually, there is a sophistication, for example, in a syndicated loan, where the way of transferring the rights in a syndicated loan is by way of a transfer certificate. The way that you transfer a negotiable instrument like a promissory note or a bill of exchange is by way of endorsement. And this is all about mechanics, so that use the right mechanics, have the right document, and you become the legal owner of that trade finance asset. If you don't want to do that, and we'll come on to reasons why you may not, there are ways that you can become involved by participating. And I use that as a term used in some of the documentation that I'll explain in a moment. I mentioned before funded or unfunded. Funded is where the payment by the participant is made up front and waits for the money to come back. Unfunded is where you take the risk, but you only pay if there is a claim. But what's important is the seller of that participation remains the fronting entity to the other parties in the transaction. And the last type of structure is we've generically called pooled structures, where the asset is held by another who issues in some way rights to the pool on that. And I'm going to look a little bit more about pooled structures right now, just to help again to see what I'm talking about. But what's a pooled structure? Well, if you remember, I said that it's quite useful to have a diversified portfolio of assets. These can be held in a pool, and that often converts the right to receive the trade finance asset directly into a claim on the party who has that right. And that party, as you'll see, may issue some other evidence, a note or whatever, to deal with how the legal relationships work. But remember my definitions from before: eligibility criteria and concentration risk, because they are important when you are pooling the assets into that diversified portfolio to make sure that you have the right type of asset, that you take the right credit risk, the right country, and so on, and that you limit your exposure, the concentration risk, to the type of asset. And of course, the question then is, who will manage this? Is it the seller? Is it an independent third party? So I've dived into the pool, and I'm just going to take a slightly deeper dive into that, because one of the interesting things about trade finance assets a lot of the time is that they may well be short term, so that they will change over time. Now that's of value, if you like, to test whether your transaction works, sales, resales, and so on. But of course, it's not helpful if you're an investor, if you want your funds to stay invested. So consequently, there may well be a change in the mix of the assets. As cash comes back, can it be reused? And of course, the test for the investor all the time is, do I always have the right to recover against the trade finance assets in that pool? Because it will be recognized that my recourse will be limited to the assets in the pool. And there are different methods to achieve this. Securitization, which I'll talk about a little bit more, but repackaging of assets, looking at them on the platform, these are all ways of doing it. But where you're doing it in securitization, there's often a special purpose vehicle or special purpose entity used to hold those trade finance assets. The idea is that that entity should be bankruptcy remote so that the contracts will work. And the SPV then issues notes to the investor, representing, in effect, the pool of trade finance assets, or a percentage. recourse is limited, so there's no recourse to the SPV as the seller of the note, and there may be very limited recourse going back to the chain or back along the chain. So what do you then get? Well, what's attractive to the investor? The quality of the note, and securitizations tend to give the trade finance investor, the non-bank investor, senior notes, first claim on the pool. Why? How? Because there's a junior set of notes sitting behind, or somebody else is taking the first loss, is taking the risk on that. The creator of this pool in some way has what's called skin in the game in relation to that. That enhances the value of the investment that the non-bank investor is making in that pool. The investor wants to know, well, hang on, if something goes wrong, well, things like stop funding, in other words, you don't have to pay any more. And if your money is there, as the money comes back, you get your money back on that. And then, of course, you can enhance the value of that portfolio with credit insurance and other credit enhancements, if you like, a wrap to make it better. Important to have correct reporting obligations, depending on who's involved, who's originated this, but you may want an independent management company to be able to tell you, because you come back to the point I raised before, true sale. In other words, the SPV, if we're using securitization, must own the trade finance asset. Now, to confuse you, the SPV buys trade finance assets from a seller or an originator. The seller acquires them from an originator or a seller. Now, I've deliberately misused terms because we need to get to grips with the party that creates, if you like, the right supplier of goods, borrower. The party that organizes how it happens might be the originator, but he then does sell them. And that's why we're trying to get the glossary of terms to work so that anybody looking at what is being offered understands who is doing what. Because the SPV now, as the purchaser of the trade finance obligations, issues notes to the investor to make the purchase. The investor has no direct rights to the trade finance assets because they're owned by the SPV, but the quality of what the investor is buying into, in other words, how good the notes are, how that is documented, is key as to whether an investor does actually want to invest in the structure we're talking about. So how do you document a trade finance asset? Let's go back to the beginning. The documentation will depend on the structure that you choose. So that's the first key point. It depends on the trade finance asset. How do you create the trade finance asset? Well, I've explained how it arises in a commercial context, in a financial context. On that. So you've got to look at, can I achieve the certainty in the creation of that asset? Are there standard documents to create a trade finance asset? Well, no, not really. Remember, if we're talking about receivables and payables in trade finance, we're talking about trade. They're commercial parties. They're negotiating with their own terms and conditions. Can we persuade them to move down? Remember that line of invoice approved, payable, IPU, etc. On that. Because once we do that, we can then work out whether the originator, now the originator here is the party that is going to sell the asset or the rights to it to a non-bank investor. Has he acquired it? Who takes what risk? Are we saying, or should we be saying, that actually, as a non-bank investor, I want to make sure that the party who is selling me something tells me he's actually bought it. And this is where you get the start of the discussion about who takes what documentation risk. Let's try and put that into some form of context. Transfer or assignment. I've told you, it depends on the asset. Full assignment requires notice and so on. It removes the seller of the asset and gives the purchaser of the asset, i.e. the non-bank investor, direct recourse against the obligor. So he has a direct relationship with the obligor, but he needs a mechanism in place to handle it, because suddenly the payment's going to come to him, not through somebody who services it on that. Is he going to take documentation risk in the transaction? Is he taking all the risk in the transaction? And then the question is, well, hang on, that sounded very interesting to me as an investor, because it was the clearest way to access a trade finance debt, but it has operational drawbacks. And consequently, it may not be what I, as a non-bank investor, want to do. Have you got another way that I can get involved? Well, the answer is the magic word, participation. Remember what a participation is in the language we are discussing. The rights come through the seller, and they are granted to the participant. They are sold to the participant in our structure. But the question then is, what risks remain on the seller? And that often is a matter for negotiation, because the seller of the trade finance asset may actually have packaged the asset very well, because he may be entitled to claims against the supplier, recourse claims against the supplier, the seller, whatever. So we need to make sure that we understand what is being transferred. Well, actually, there are a couple of very good documents that work as a starter in our discussion. The first is the BAFT Master Risk Participation Agreement or Master Participation Agreement. That's very flexible, used for all sorts of different assets, from loans to deferred payments to and including receivables and so on. And it works for both funded and unfunded. It's a good document. Recently released, as recent as last week, ITVA released AMARA, its Master Accounts Receivable Assignment, but for use with payables and receivables when funded on that. That's important. Now, I want to have a look a little bit more into those two documents. The trouble with standard forms. Now, many of you know that I've been involved for a number of years with the BAFT documentation. This is not a criticism of the BAFT documentation, but I'm trying to put this into the context of the sale of trade finance assets. Just bear that in mind. The MRPA cleverly designed two-way. You could be a seller or you could be a participant. So it's balanced. To be more flexible, it has a concept of master party. So if you're a bank and you may use different branches, you may use subsidiaries, but you can negotiate separately by having a master party. The point is it too complex to do what we're talking about? Because it generally assumes that each party can assess the underlying trade transaction, because the BAFT was designed to work between banks. And it assumed that seller said, here's the documents. Participant said, okay, thank you, I'll have a look at that. That could mean that investor may take documentation risk. Question, does the investor want to do that? Could we change it? Should we change it? Should there be a more tailored approach where the investor says, well, I'm always going to be the buyer. I'm always going to be the participant. I don't want all this two-way. Now, we do that at the moment on a transaction by transaction basis. And there are many variations that are being used of participations. Is there an advantage in standardizing it? That's something for discussion on another day. So there's been an attempt to standardize it, you might say, with the ITFA MARA, but it's two-way again. It's used for funded distribution of receivables and payables. It creates an assignment mechanism. Remember what I said, but an equitable assignment. In other words, there is no notice served on the payer. So there is a structure because the seller of that receivable remains, if you like, the title holder of that. And then there are structures that you may have to think about. Is it committed? Is it uncommitted? Is it one-off? Is it revolving? What about documentation risk in the underlying transaction? Do I negotiate that? Do I insist on a quality of asset? If you thought that was difficult, we get on to documenting securitization. Now, documentation is more complex. There's a setup cost for an SPV or a structure like the Luxembourg structure that many of you may know, where you don't have a separate legal entity, but you have what are called compartments. There are legal costs. There are legal costs of transferring the assets to the SPV, of working out when the notes are issued by the SPV, is it secured on the trade finance asset? How does all of this work? What are the rights of and what's the recourse? I suggest this might be the subject of another webinar where we can look at pooled structures and other types of structures. But I hope you've got enough just to get an idea that securitization is a useful mechanism. Pooling of assets is useful, but it's not quite as easy as it may always sound on that. Let's take a pause for 1 millisecond and then look at, actually, if I'm an investor, what am I buying? Can I just take credit risk, i.e. non-payment by the obligor? In other words, non-payment by the buyer of goods, by the borrower, by the issuing bank. What about my recourse to others? What am I looking for? Am I looking for a guarantor? Am I looking that's, and this, of course, all depends on a number of factors as to whether you can make it simpler or not. And it depends who you're talking to. If banks talk to each other, they talk about, oh, yes, we're going to have an IPU. But if the banks are talking to the investor says, do I know where you're getting? Do I know what you're really saying to me? Can I trust you? If you're talking to the commercial parties say, what do you need from me? So how do we get there? Well, the answer is we're discussing education. Hopefully, webinars like this begin to unpick some of the issues, and then give some explanations to whom. Well, as far as I know, in this audience, there are no suppliers or buyers. In other words, they're not the key people who create the trade finance asset, the commercial parties. They need to understand. I don't think I have many borrowers listening. I've got more lenders, I've got more platforms and so on. Once you've got all the explanations out, documentation, then it seems to me can be made easier. But where do we go from here? Well, of course, you may take the view that I don't need to change anything because there are quality assets already available, which I'm using. And of course, those quality assets invariably come from quality obligors. They come from very good quality buyers who are taking advantage of what is being offered in relation to particularly things like securitization, payables agreements, and so on. But the question is, what about bringing in other parties? What mechanisms would you use to bring in other parties? Well, of course, the focus on the digitization of trade has put trade and trade finance very much in the spotlight. And therefore, it's posed some very interesting questions as to how can I bring other parties in? How can I explain what they are missing, and therefore what is missing in this world of trade and trade finance? And I used numbers. I used a number 1.5 trillion of unbanked but clearly bankable trade finance assets. And somebody said to me, well, that's too small a number. And I said, okay, well, I don't mind because 1.5 trillion is probably enough for most of us to be getting on with. The message is that there could be more trade finance assets if we can deal with how they are created. And consequently, whether it's the quality assets that people are talking about at the moment or this new set of assets, there could be more investors. In other words, if I am an investor, a fund looking to invest, and I say, well, how can I do it? Can you explain this to me? Well, the existing initiatives that we're talking about, I hope will help achieve that. But where do we start? Well, that's a good question. And the first point is, well, we can approach this from all different angles. So the first is increased trade finance assets. How do we do that? We need to explain what we need to those who create the asset. In other words, as I say, supplier, buyer, borrower, lender, issuing bank, and so on. How do we involve more non-bank investors? Well, we have to be able to explain to a non-bank investor what you obtain when you invest, how you get there, what the documentation looks like. And that may well mean refining structures, as I've begun to indicate, and perhaps changing documentation, making it a degree more simple, or piecing out, cutting out, slicing risk, and so on that. But what is this all about? Well, the answer is that this is all about how you increase trade finance assets. Now, this is where, if you like, I get slightly more controversial, because my thesis for you is that we need more suppliers and buyers. In other words, those who are involved at the moment really know what they're doing. They've made their decisions. I worked on a transaction involving a very sophisticated buyer who said, look, in relation to my payables, I want to control who has a claim on me for goods that I am buying. And therefore, you will not have a free right to negotiate. I want to approve every single acquirer of my trade finance debt. That's difficult. That's a long way away from the promissory note, the unconditional promise to pay that can be fully transferred, fully negotiated. So my point, therefore, is we need to target others. We need to target SMEs in different markets and not just major buyers. Because those commercial parties may well be very receptive to what we're talking about and may well be prepared to document the payment obligation in a better way. And last week, when I talked about ITFA, and I said ITFA stands for the International Trade and Forfeiting Association, and the F, the forfeit, came from forfeit, to give up, was a mechanism whereby the buyer of goods gave up the right to withhold payment in exchange for better terms for itself or for its supplier. That idea has a way of reviving what we've talked about. So I've said digitalization of trade, but also the certainty. Promissory note digital form or otherwise, or bill of exchange. All of those represent unconditional promises to pay a sum certain, therefore well suited, if we want to supply contracts, to loans, and so on. And you get to the famous IPU and so on. Put simply, the better the buyer payment obligation, the better the trade finance asset is to the party who wants to invest in all of this. So let me try and sum all this up. So is there an attraction for non-bank investors? Well, the answer is, I believe there is, because if we can achieve what I have been discussing, which is these certainties, these good structures, what you then have is a good quality, but a variety of trade finance assets that would be pleasing to specific investors looking at particular markets, looking at particular sectors, looking at particular credit risk. And if you add to that the addition of credit support, now I've mentioned on a number of occasions credit insurance. The rules of the game that I mentioned has a section about credit insurers and how insurers want to become involved and how they can become involved. But there's more to it than that. Some of the DFIs, the ECAs are also prepared to become involved in supply chain, in the furtherance of non-bank investors into the trade finance asset sector, even if they deal with a bank and the bank then creates the transaction, the participation transaction for non-bank investors. The more we increase the understanding of how you can become involved, the greater the possibilities are of being able to become involved. And that requires or may require changes of structure, because you may argue that the structures that I have already outlined, remember, transfer, participation, pooling, that may work. That may be more than sufficient with variations to be attractive enough for a non-bank investor to want to invest, and more importantly, for those who are involved in raising money, deferring payment, and so on, to say, yep, I now see what you're talking about in relation to the quality of the trade finance debt or the trade finance assets, that I'm prepared to listen and discuss how to change it. Now, changes in documentation may help. I'm a lawyer, I would say that. The documentation is clearly, it seems to me, an important way of achieving exactly what you want in relation to how you get involved in the transaction. If the documentation is more straightforward, the easier it is to understand it. So if instead of 200 pages, we can reduce the number of pages, we clearly make it easier for the parties to see exactly how they want to be involved. And I hope after my explanations that this is an area that you want to be involved in or more involved in. I hope you agree that it is an interesting area to become involved in. I'm happy to, in the few minutes available, to take any questions. I can see I am just looking at some questions on the chat line. Somebody asked the question, what's the pitfall of assigning instead of transferring? The answer is assigning is just a way of transferring. It's just a legal way of doing it. So please don't get confused in relation to transfer is a generic way of moving, if you like, the rights from one to another. Assignment relates to an English law concept of debt. And we, of course, I'm afraid, complicated matters way back in 1925 with our Law of Property Act, that you can have an equitable assignment or you can have a legal assignment. And I won't go on to that because you'll all go home. Somebody asked for a copy of the ITVA Mara. That's available, as far as I know, on the ITVA website. It's available to ITVA members. Lengthen the document. Somebody asked about lengthening the documentation in open account. No, actually, it is what it is. Documentary credits are interesting because they use UCP 600. So it's a letter of credit. It creates a payment obligation. The frustration, if you like, as a purist lawyer, is that most letters of credit do not have a governing law. So you have to try and work out exactly what is going on. But I'm not suggesting open account is better than documentary letter of credit. What I'm saying is they all create an investable trade finance asset, and that's what's important. Somebody just asked a question for which you would normally have to pay quite a bit of money. Does an equitable assignment achieve a true sale? The answer is it can well do in relation to that, depending on how you write it, how you structure it on that. But it is a complete, if you do it as a complete sale of, in English terms, the beneficial rights to 100% of that underlying asset, which needs only a legal perfection meeting a legal assignment, you would have sold it. You would have a true sale of that asset. So that structurally, we can achieve a lot. The fact that you're showing an interest of how to structure, I hope means that there is a growing interest in the asset class, in getting involved in it. We are running up to the end of time. I'll give you a moment. If anybody else, I see nothing on chat and I see nothing else on Q&A. So on that basis, I thank you very much for listening. Our next webinar from the team will be on the 30th of May, the last Thursday in May. We're going to look at some sort of compliance issues, but we're looking at them in a trade and trade finance context, hopefully looking at things like ESG and so on, and just what is going on in relation to the trade finance asset class on that. So on that basis, I will wish you, as I generally do, a good time structuring, and I look forward to seeing you all again at wherever on that, and enjoy the rest of your day. Thank you very much.